Hello, good weekend to all. It's Adil Fazal, market analyst at CFDs.com, bringing you a review of the European indices for the week commencing the 22nd of February 2016. This video has been brought to you by CFDs.com. Be sure to visit the site and see the products and services available, and certainly take advantage of that new cash or new account opening offer. Alternatively, you can visit the educational site www.cfd.education to certainly learn more. Okay, let's try and understand exactly where European markets are headed. Going into Monday's trading, we have data deluge in Europe. We have French, we have CHF Swiss. Well, we have mainly it's French and German and Italian, and the Eurozone as a whole, PMIs, so services and composite and manufacturing PMIs. Although we have a German Boomer monthly report that should be quite interesting, and we have the CBI Industrial Trends Survey in the UK. That will be the data that we're going to be focusing on. Although the Brexit concerns certainly have been alleviated somewhat with regards to this deal that was struck late into the Friday evening session, and it will be interesting to see how the FTSE 100 reacts and opens with regards to that. Okay, now, although it is a watered down version of what everybody expected, it certainly seems to be sufficient enough to well, again, sterling will dictate the actual reaction, but it certainly looks sufficient enough to keep the UK, the British in the European Union to a large extent. Now, in the US, we have Chicago Fed and obviously US PMI data as well. Then we have Mr. ECB's Locht and Schleger speaking in the evening at 6 p.m. Okay, so that's Monday's trading and Monday's price action. In terms of Friday, we had stronger inflation data out of the US to a large extent, which obviously reignited the potential rate hike trade and certainly strengthened the dollar somewhat, although Mr. Mester had comments were certainly interpreted in the other opposite direction. So again, that certainly is circumspect. We had UK retail sales and CB leading economic index certainly stronger in the UK, so economic data certainly supporting the FTSE 100. Also, we had the rig count fall as well late in the session, which again, Baker Hughes US oil rig count came in at 413 from the previous 439. So again, that supported oil to a large extent. Okay, right. Bear in mind, we do have the Mr. DeBella speech on the Aussie. That should be jawbone in the Aussie and send that lower as well. Okay, now let's try and understand exactly what's going to happen with regards to European markets. Now, the markets are now being dictated by currency movements, i.e. central banks. So before you do anything, and this is something that I would encourage every trader to do, is to look at the actual currency market. You can't trade the indices without the currencies. Okay, I mean, that's just generally into market analysis philosophy anyway, but even more so given the extent of the intervention by central banks. Now, one of the key variables I'm looking at going into the in the weekend and going into Monday's trading session is the Euro USD. Now, even though we had the stronger inflation number out of the US, and that should have supported the dollar, okay, to a large extent, the euro managed to rally off the lows and create a double bottom. Okay, even with Mr. Draghi's speech with additional QE and so on and so forth, even with weak German inflation data as well, it certainly seems to be the case. Obviously, the PMIs on Monday will have a massive effect on the Euro USD, especially if they come in weaker. Obviously, that will send the Euro USD weaker because obviously it means more QE and so on and so forth. But the way in which things stand at the moment, it certainly seems that the even though the Euro USD has been higher and it may well impact the trading and the actual economic data going forward, but for now, obviously the situation with regards to the banks and the confidence and so on and so forth, because the European consumer confidence certainly came in weaker on a Friday as well, the EU consumer confidence number. But nevertheless, again, all eyes on the Euro USD. If the economic data comes in line and potentially stronger, then the Euro USD will certainly push higher because there's less chance of QE. A higher euro generally means that the stock markets will certainly fall. Okay. Now, if you look at the Euro USD chart, you can see that we've hit this pivot high on the daily chart. We reversed and retraced at this resistance zone. A key resistance zone is at 1.1414 up to 1.15. We've come back and retested the breakout level. Okay, if we do fall further, then you do have the next support at 1.1. Okay, but for now we are holding that 1.11 level. Okay, 1130 level, which is a 200 MA support. So if the euro certainly pushes higher from here, given the fact that if you take the Fibonacci retracement from the pivot low to the pivot high here, you are into that 50 to 61% support. And that certainly will act as a potential support zone and lift the Euro USD higher. Okay, now if we look at the chart versus the dollar index, and this is the one that's the most perplexing. Let me just bring up the dollar index for you. That's the yen. Let's bring up the dollar itself. Now the dollar has a confusing signal as well. If you look at the 4-hour chart on the US dollar, you have a potential for an inverted head and shoulders formation. If you bring up the daily chart of the dollar, you have a potential H&S formation. Okay, so it's which one do you go with? If I bring up the, bear with me, let me bring up the other dollar index, which is a 24-hour dollar index. Okay, which is the dollar futures. Okay, you have an inverted head and shoulders on the 4-hour chart. On the daily chart, you're into that previous support equals resistance. You have a topping tail on the dollar index with an unfilled gap below. Okay, now even though Mr. Mester did negate negative rates, he certainly factored that out of the equation. Okay, and his comments overall, from my perspective, certainly were interpreted, from my understanding, was relatively neutral to stroke hawkish. Okay, and it should have sent the dollar index higher, especially with higher inflation data coming out of the US since, I think, the last 2 years. And that certainly wasn't enough either. So one would lead to believe, or makes you believe, that the dollar is certainly pushing lower to close that gap below. And in turn, it's going to send the Euro USD higher, which in turn, as we all know, for the USD JPY trade, which is very important. Remember, it's the Euro, the Yen, and the Yuan. Okay, that's the three currencies that are of importance at the moment. Okay, so when the Euro moves lower, stock markets rally. When the Yen moves lower, stock markets rally. When the Chinese renminbi moves higher, okay, stock markets rally. So that's what you have to focus on in terms of your trading. Okay, now if I bring up the chart of the USD JPY, you can see this is getting absolutely crushed. We're holding that gap fill, important gap fill region at 112.3. Where do we go from here? Okay, if the dollar is obviously holding this double bottom support, then the USD JPY certainly moves higher. Okay, but that will then send the yen lower, will send the euro lower. And we all know what happens then, the stock markets rally. But what if that support doesn't hold? Okay, going to the weekly chart of the USD JPY trade, it certainly is in a downtrend. I mean, you can clearly see there's a H&S formation. You've got your left shoulder here. You've obviously put in your head. You have your right shoulder, and down we go. The H&S target on here would be the pivot high is at 125. So H&S target here, 125 on the basis of Abenomics failing here. So and obviously a risk aversion trade is triggering off here as well. So 125, what's it, 125 point, let's just call it 126 for the sake of making it simple, down to the potential 116 region. Then you are looking at 106 on the downside. So certainly more pain to come. Okay, the next level is 110 below. Okay, if the 110 level were to fail, then the next level you're looking at is the 106 level, which is the 200 MA. So there is going to be a major risk-off event. That's what this chart is forecasting. There's going to be a major risk-off event, which is going to trigger a global market sell-off and a meltdown. So let's look at the banks and start to see what's going on with the banking sector. Could that be the catalyst that will cause this major risk-off and global meltdown? That's the question we need to ask ourselves. Will it be that the ECB is not going to do additional QE? Hence the reason why the Euro USD is going to rally, the dollar will sell off, and the USD JPY trade certainly moves to the downside as well, because the dollar index does not move higher. Could that be the case? So these are all factors that you have to certainly take into consideration and certainly discuss. So given the fact that the USD JPY is now back at the 112 region, that's not very good news for the Nikkei. Let's bring up the chart of the Nikkei now. Okay, the Nikkei certainly remains in a downtrend. It's in lower lows and lower highs, and it certainly remains bearish. I can't see any reason why you'd like to be bullish at this juncture. Given the fact that we have an unfilled gap left below as well, and the USD JPY trade is trading at back out to the 112 region. Therefore, you are looking at potential risk off. Okay, let's bring up the Shanghai. The Shanghai chart, yes, we are holding that 200 MA, but it's still an inside bar on the weekly chart. We're still holding previous resistance, or previous support equals resistance, and therefore you have the possibility or the probability of retesting that potential low. and the daily chart could certainly fall even lower. So this is an interesting scenario. Also, bring up the renminbi. Let's bring up the renminbi chart. Let's see exactly where that's positioned. The Chinese S&P Chinese renminbi. We've put a topping tail on the renminbi. So what does that mean? We have multiple unfilled gaps. That means that the yuan has stopped rising. Okay, and therefore it's going to fall. If the renminbi or the Chinese yuan is going to fall, that means that global trade will go avert towards China to a large extent, and it will help the Chinese economy to a large extent, but it will trigger a global risk-off scenario. Okay, it will trigger a global risk-off scenario because the Europeans and the US need China's trade to stay afloat. Okay, and that will create fear and that will create panic. And as we all know, last time what happened when the yuan fell, it created a risk-off sentiment, a risk-off environment. So you have the situation here now with the yuan topping out, and it's going to move lower. That's going to move lower. That's going to create a risk-off scenario. The Japanese are going to suffer at the expense of the Chinese currency being devalued. The yen will start to strengthen. Okay, the yen will start to strengthen. Okay, because obviously it's a zero-sum game, so another currency has to fail. Okay, and has to suffer. The euro will strengthen. Okay, and that's going to create a risk-off trade, and that may well be the case where European equities will sell off. Okay, these are all scenarios. Okay, these are all scenarios, hypothetical scenarios. Okay, that as a trader, it's like simulating a war game. That's probably the best way of explaining it. You simulate the war game and you look at all the potential scenarios and outcomes of that war. Okay, and whether or not you win. Okay, same thing with playing chess. Look at all the potential scenarios of your opponent's move and your move, and see what the outcome is. Obviously, choose the optimal solution. Same thing here with regards to trading. You have your stop loss in place, and you choose the optimal solution with the one that has the greatest probability of success. Okay, so food for thought. Okay, now let's bring up the yen as well. The yen is going to be an important chart. Let me bring up the yen and chart of yen. You do have a topping tail on the daily chart, so this is a very tricky trade. Now, as again, it's a double top on the 60-minute chart as well on the yen. So we need to ask ourselves. I mean, the weekly chart certainly remains bullish on the yen, and certainly a potential. Nothing stopping it from making new highs. Daily chart certainly has a topping tail. You do have two unfilled gaps left behind. It's basically which one is Pinocchio. Okay, so if the yuan continues to move higher, then the yen and the euro will move lower. If the dollar starts to potentially reverse and move higher, then the yen and the euro will move lower. If the dollar starts to collapse, then the yuan collapses. Then that's the situation that you find yourselves in. It's a zero-sum game. Which one of these currencies will obviously win out? Now, again, the yuan is the most important. If that starts to move lower, European equities, US equities will sell off quite sharply. If the yen starts to move higher, then we all know what happens there. The Nikkei moves lower, and obviously the rest of the market suffer as well. The Euro USD is positioned very bullish. So as we all know, the Euro USD has become a safe haven currency now. Okay, because of the QE trade. So whenever the QE trade is not working, people are not buying European equities. They will then sell European equities, and they'll have to close the euro short trade. Okay, and then that obviously triggers a short squeeze, and etc. etc. So we all know the trade of the given the QE from Mr. Draghi, the trade of the town is short euro, long EU equities. When risk comes off, the opposite occurs, and everything goes into a liquidation mode. Long squeeze on equities, short squeeze on euro. Okay, so that's just food for thought, folks. Okay, bear that in mind. The yen, the euro, the yuan, the renminbi. Okay, they are the key currencies to observe. Also sterling as well, with regards to the reaction of the Brexit scenario, etc. So EU UK deal. Okay, now given the fact that I've talked about currencies, let's focus on the actual equity market now. Let's bring up the equities and let's see exactly where they are positioned. Bringing up a daily chart of the Eurostoxx here, folks. You can clearly see that we are into that bearish channel. Okay, upper channel resistance on the Eurostoxx, and therefore this remains weak. We still remain in the concept of lower lows and lower highs, and therefore bear trend is intact. We are holding that FTSE 61 to 75% resistance and the downward sloping diagonal trend line. So you ask yourself this question: is the Eurostoxx going to break out the 3050, thereby sending the Euro USD lower? Okay, which I've already explained to you. So if I bring up the chart of the Euro USD, as we all know, when European equities move higher, then Euro USD moves lower, and vice versa. So you need to ask yourself that question. Is the euro going to collapse here at this 1.1050 zone and break lower and go back and test that 1.08 zone, thereby sending European equities higher? But for that to happen, the dollar must start to strengthen. Okay, the dollar certainly has a reason to strengthen given the stronger inflation data, but is that sufficient enough? Interesting, isn't it? Okay, so it's very important now for the dollar to start to rally, because individuals need to have faith in the US markets ability to increase interest rates, which in turn helps the USD JPY trade, helps the Euro USD trade, and keeps the global stock markets confident and equities moving higher. Okay, that's just central banks for you. Okay, so it's become a real conundrum now to actually forecast these markets. It's an absolute headache as a day trader trying to navigate between all these multiple variables and how individuals react with regards to QE in the background. Okay, very, very tricky right now as a trader. I mean, the days of me nailing 400, 500, 600 points a week in my sleep are long gone. I mean, it's very, very hard. Last week I was up 100 and something points and I ended up with minus 50 in the end. So it's and this was last week as well. So it's a tricky market. Okay, this week I was more or less negative majority of the week actually. Last week that was the equation. Last week just about managed to scrape to finish positive, and this week I was more or less negative from the start of the week given the immense rally, and then I ended up with plus 10 points on a Friday morning, and then obviously eventually stopped out on the Kiwi and Aussie trades and minus 50 points of the week. So very hard to read this market right now, very, very tough. And that move in the FTSE 100, very, very impressive, okay, without a single pullback as well. Okay, so with regards to Eurostoxx, you can see that you have an unfilled gap below. Watch out for that gap. The gap fill is at 27.60. Now, given the Euro USD is into support, there's a high probability of that gap closing. Okay, high probability of that gap closing. Okay. Now, the 60-minute chart. Let's go into the 60-minute chart. The Eurostoxx. You've certainly pushed higher here in Eurostoxx. You are into previous resistance equals support. So certainly watch this zone. Although we did have some comments from Mr. Visco, buy bad loans pro QE. So he said that the Eurozone could certainly, or ECB could certainly buy the bad loans of banks, and that certainly is supporting the equity market. Mr. Draghi's comments of him observing the banks and watching the banks certainly is supportive of the equity market. So given the fact that Mr. Draghi has basically more or less put his Draghi put in place, or certainly has the markets back, so to speak, then one would presume that the Eurostoxx would not go lower than the pivot low of 2680. I don't expect that pivot low to be broken now going into Draghi. So any dips certainly is a buying opportunity prior to Draghi. That's my or the Draghi's March meeting. So there is a high probability we can close the gap below at 2750, and obviously this gap below at 2680, because stock markets, that's what they do. They look at price points and they will potentially close those gaps. So given price action, you are looking at that gap being closed from my understanding. Okay, so key support zones will be 2800, gap fill at 2750, then obviously 2680, and we'll watch out for those zones. Okay, right. Eurostoxx 10-minute chart. Let's just observe. You certainly have built a base here now. You've broken out this downward trend line. You complete the H&S formation at 28.50, so that 28.50 support pivot low at 28.45 remains key. Although you do have an unfilled gap at 28.20, and then obviously you have horizontal support slightly down below. Let's just bring that into the equation. Zone is there. And then the ultimate gap fill at 27.60 certainly needs to be watched out for. Okay, that's the situation with regards to the Eurostoxx. Now let's cross-reference the Eurostoxx with the S&P Europe 350. Again, lower lows, lower highs. The target of the unfilled gap remains below at 1265, and that is a zone that you all have to observe. Okay, I certainly expect that potential gap to close before we attempt to mount any rally higher. Do we have an inverted head and shoulders brewing? Yes, we do. My philosophy my thought process or hypothetical scenario going forward is that we've put in the left shoulder, we've put in the head. all we need to do now is close this gap and off we go to the races going into Draghi's potential QE meeting, okay, in March. Okay, so that QE bazooka about to be unleashed. The right shoulder needs to close. We need to close that gap and then off we go to the races. Okay, Stock 600 is an index that I always cross-reference and cross-verify everything with regards to. And again, same scenario here. You have the unfilled gap below. That gap certainly needs to close from a technical perspective before we start to rally higher. We're in this bearish channel of lower lows and lower highs, and Draghi certainly has ended that from my perspective with his speech on potential banks being observed and looked at as a firewall for any future sell-offs. Okay, so again, watch out for that. Now, whilst we're on the topic of banks, let's bring up the banking sector. The banking sector is Deutsche Bank. Let's look at the chart of Deutsche Bank. The monthly chart certainly has put in a bottoming tail and is holding that double bottom. So that's bullish for European equities overall. Weekly chart, you can clearly see that bottoming tail with Mr. Draghi coming in and asserting his authority and observing banks and so on and so forth, and several individuals from the European ECB, etc., and reassuring everybody that the banks are safe and blah 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 blah. And obviously with regards to bad loans being bought and so on and so forth. Okay, daily chart of the banking sector, you can see that we've certainly held that downward sloping trend line. We have consolidated. We have had two back-to-back days of bearish price action on banks, but it's all about closing those gaps above. So watch out for those gaps. 60-minute chart of the German, the Deutsche Bank. Again, you can certainly see weakness here. We certainly have support below, but I don't expect that pivot low to be taken out unless there's some real bad news. But for now, you are looking at pivoting towards that gap below, closing it, and then start certainly setting up a stellar rally in the banking sector. So watch out. Okay. Okay, right. Again, financials. Let's bring up financials. 350 financials. Here we go. S&P 350 financials. Let's just bring up the weekly chart. Again, you can see we have held that potential support zone on the weekly chart, although it's an inside bar, so it's not very convincing. The daily chart, again, as you can see, so more or less the European indices are the chart of the banking sector, because you can see that unfilled gap below. Okay, look at that unfilled gap below, and you are looking at potentially creating this inverted head and shoulders formation. So you have this right shoulder here, you have the left shoulder here, retracement, moving lower, closing the gap, and then off we go to the races. Okay, we break out of this bearish swing or potential move lower, and then off we go to the races. So we certainly start to move higher. Okay, so that gap is what we're going to be targeting this week. So bullish, but not extremely bullish. Okay, bullish to the extent that bearish to the extent that we are looking for a slight retracement, and then obviously the markets are set up to rally quite handsomely. That's my interpretation. That's my understanding thus far of this market. Okay, so it's going to be very, very important. Okay, right. So the next scenario. Okay, let's have a look at the potential next scenario. Okay, so now we looked at the banking sector. Now we've looked at because the banking sector, as we all know, is very, very important. Let's have a look at the energy as well, because oil prices certainly seem to be dictating everything along with the financials. So let's see exactly where we are with regards to this. Okay, right. The chart of the energy sector. Okay, this is going to be interesting. This is why the FTSE 100 has been very, very stellar as of late. I didn't expect to be as stellar. You can see that the energy or financials itself and the daily chart has put in a double bottom, and you can clearly see that we have an inverted head and shoulders formation here too. Okay, so what is this telling you? This is telling you that we are now going to rally quite hard and very sharply on European indices. So one would certainly keep a bullish bias on the actual market itself. Okay, but for now you have an unfilled gap below that we need to close, and that gap certainly needs to be watched out for. So bearish, but not overtly bearish. Okay, not extremely bearish, just mildly bearish, looking for a short-term pullback, and then certainly the bulls certainly will be sharpening their teeth and certainly looking to pounce on the bears and certainly push this market higher. So as long as the oil sector certainly holds, the market certainly remain bullish from my perspective. Okay, let's look at the actual price of oil as well whilst we're at this juncture. Bring up a daily chart of oil. You can clearly see again there's an inverted head and shoulders brewing now. 4-hour chart, as you can see with regards to the energy sector index, you can clearly see it's certainly confirmed and replicated on the chart of oil. 4-hour chart, you can see this inverted head and shoulders formation in play, and therefore looking to potentially move higher. So Monday, Tuesday, looking at a right shoulder being built again. PMI data, it's a wild card. If they're coming weak out of the Eurozone, then that may well create more concern, and you could get a risk off trade. Okay, so again, Asian markets, how they'll react. Again, it's with regards to the yen. If the yen fails to hold that double top, starts to move higher, USD, JPY starts to move lower, that's not a good sign. Okay, so there's so many scenarios that could occur. You just need to be aware in advance as a trader. Okay, in advance. Okay, right. Let's look at the German DAX now. The German DAX on the daily chart, we are now into resistance, holding that fib 61 to 75% retracement. You have an unfilled gap to close at 9,000, so we can certainly revisit that. The 60-minute chart on the German DAX, we've broken out the key diagonal trend line. We are looking to potentially move lower. The 10-minute chart of the German DAX, you are into that resistance zone now, diagonal trend line. 9,400 is resistance. Any move higher, you are looking at resistance at 9,430, and then you have resistance at 9,475, and therefore you are looking at potential move lower. Again, that unfilled gap at 9,130 certainly seems appealing as a potential gap fill candidate. The target on the HNS is 9,210, so certainly watch out below. Okay, right. The MDAX is always something that I look at in order to confirm any weakness in the German DAX, etc., etc. And you can certainly see that by taking the pivot highs and connecting them together. Okay, again, you have that unfilled gap below that certainly needs to close. So that culprit certainly is your candidate for the gap to close below. Okay, again, we need to look at a catalyst. We need to look at a fundamental catalyst that will trigger that. And we all know that the Euro USD is certainly into support, and therefore you could look at a potential sell-off in the markets. Okay, again, this certainly has the same inverted head and shoulders formation. Okay, you can see a left shoulder here. The head is obviously here with the bottoming tail. The right shoulder, and off we go to the races to close this unfilled gap below here. And then we have an unfilled gap up here. Okay, so gaps that we certainly need to fill. Okay, so again, this is something that you need to observe. Okay, so certainly we are, well, basically Mr. Draghi certainly has put a pivot in this market. Don't expect a new low in this in global equities, but you are looking at a temporary sell-off, and then you are going to rally quite sharply from my understanding. So certainly weakness on the MDAX 50. Tech all share, again, this is another index that you need to observe, and you can cross-verify this as always with the NASDAQ, which is quite important, okay, as a trader. And this certainly is indicating resistance from my perspective. You have this Fibonacci retracement, take the pivot high, take the pivot low, and you're now into that fib 61 to 75% resistance, and therefore you are looking at weakness down below. Take the pivot high, connect them together, you are into that diagonal trend line resistance, and therefore you are looking for potential weakness. But overall, you can clearly see this is your left shoulder here. You've put in your head, looking for a nice right shoulder, then obviously the market looking to retrace quite powerfully. Okay, right. In terms of the French CAC, let's bring up the French CAC now. Let's see. Everything certainly seems to be aligning so far for temporary weakness, and then you are looking at a potential rally. The French CAC on the daily chart, you are looking at diagonal trendline resistance at that fib 75% resistance. You have an unfilled gap at 4,000, and that certainly seems to be the target. Again, you have the inverted head and shoulders, left shoulder here, head, right shoulder, off we go to the races to close those unfilled gaps above, and you're looking at 4,600, 4,700 target on the European indices. Okay, right. Looking at the smaller time frame of the French CAC, you're looking at temporary weakness because you've broken out the rising contracting wedge pattern, and you are looking to test the 4,150, 4,160, and then down to 4,80, potential 4,000 close as well, given the unfilled gap below. 10-minute chart, you are looking at resistance at 4,230, 4,250, 4,260, 4,280. They are all the zones that I will be looking at potentially shorting the market going into Monday's trading. The unfilled gap below remains at 4,110. That will be the first potential target on the downside, okay, in terms of this market. So certainly weakness on the French CAC as well. Now, given the fact that my European indices are indicating resistance to me, that will basically come to the that certainly comes to the summation that The FTSE 100 certainly is into resistance as well, and therefore looking to potentially move lower. Now you do have this uncertainty with regards to the Brexit scenario and what will happen there. That I think the uncertainty and the fear going into the June 23rd referendum will be sufficient enough to keep FTSE traders at bay, and you are looking at this resistance level of holding unless the financials break out with immense conviction and energy sector certainly breaks out to new highs. Okay, so it's interesting, and it'll be important to see how along that right shoulder certainly takes to consolidate and form before it triggers a move higher. Again, you have the unfilled, you have the bottoming low, where you have the pivot low of this green candle at 5,860. Provided we remain above there, we will remain bullish. But it'll be interesting to see how much of the Brexit phase trigger a risk aversion trade in the FTSE. Given the fact that we've already had a stellar rally from the pivot low of 5,500 up to 6,030, my bias would be bearish on the FTSE itself. Okay. Now, given the fact that uncertainty and fear has been alleviated to a large extent, but the referendum and the two arguments to and fro for staying in the EU will certainly cause a lot of fear, uncertainty, and will certainly be vulnerable to a sell-off. And you are looking at a potential right shoulder on the FTSE as well before we start to rally higher. Okay, let's look at the 60-minute chart of the FTSE 100. We are into that fib retracement of 50 to 61%. Ideally, you do need to go lower and test the 5880 level, 5850 level of that 200 MA will be support in the interim. 10-minute chart, we are into that bearish channel. Again, it's all about that unfilled gap below at 5850, and I think that will be the target. That's the zone that I'll be looking at. I won't be surprised to see the FTSE gap down at 5850. That will be that certainly will not be a surprise, even if it comes onto Monday's trading, and 5820 is a support level as well on the FTSE to watch out for. But I will certainly be watching the FTSE and looking at potential shorting opportunity with regards to the concerns regarding Brexit. Okay, and that certainly still will be the main theme going forward into June. Okay, I think that's a market wrap for European indices. So again, given the uncertainty and the weakness of the PMIs, given the higher or stronger euro, that should certainly hurt the PMI data, and that may well be the catalyst for risk aversion and risk off. Given the fact that you've had stronger inflation data out of the US, that may well hurt the actual commodity trade, given the fact that you have a stronger dollar. And if Asian markets are down overnight and the Nikkei is down as well, with USD JPY being at 112, I think that is going to trigger a risk off trade, and I am looking for weakness going into Monday's trading. Okay folks, risk on, risk off, wax on, wax off, trade safe, and be sure to visit cfds.com for your trading needs. Goodbye now.